In the silence after a crisis, there's one question every investor whispers. Where is it still safe? Welcome back to FluxFolio Finance. Today, we explore what may be the defining financial debate of the 21st century. When the old certainties crumble, what remains worthy of trust? Gold? Bitcoin? US Treasuries? Or something else? Something abstract, architectural, algorithmic? Because in 2025, with nations knee-deep in debt, central banks boxed in by credibility traps, and the very definition of value being rewritten, the concept of a safe haven no longer rests in vaults or codes alone. It lives, if it lives at all, in strategy. Let's begin with the most ancient of assets, gold. For over 5,000 years, gold has endured every currency collapse, every empire's fall, every war, plague, and panic. It is metal forged not just in earth, but in memory. It cannot be defaulted on. It cannot be hacked. It does not rust. It does not lie. Gold is the fallback of civilization. When trust disintegrates, gold remains. In 2025, gold trades at $3,167.50 per ounce, a record. Central banks are not just watching, they're buying. The People's Bank of China quietly accumulates. The Reserve Bank of India triples its holdings. Germany repatriates. Russia diversifies. Even Singapore and Thailand are stacking reserves. Temples in India gleam with inherited bullion. Iran uses it for trade. Venezuela has bartered it for fuel. Across history's fault lines, gold whispers, "I do not care who rules, only that I survive." But gold, too, has flaws. It yields nothing. It is cumbersome, dense, and expensive to guard. Try moving $10 million in gold across a border, good luck. It is not programmable, not divisible by algorithm, and not native to the networks that now govern capital mobility. It is memory without momentum. Now step into the age of code. Enter Bitcoin. Born from the ashes of 2008, when Wall Street nearly imploded on its own greed, Bitcoin appeared as a mathematical rebellion. A trustless, peer-to-peer ledger. A protocol for sovereignty. No CEO. No board. Just 21 million coins, etched forever into open source. In May 2025, Bitcoin soars past $103,700. A decade ago, that number would have been madness. Today, it's strategy. Trump's Strategic Bitcoin Reserve Act, signed into law in March 2025, authorized U.S. Treasury holdings of BTC. BlackRock's IBIT ETF manages over 353,000 BTC. Fidelity, ARK, Franklin Templeton, they're all in. Tether, the largest stablecoin issuer, backs its currency not just with U.S. Treasuries, but with indirect Bitcoin exposure. Even the Federal Reserve, once dismissive, now hosts private briefings on crypto-backed reserves. Bitcoin is no longer fringe. It is furniture in the new financial cathedral. And yet, Bitcoin trembles. Its volatility remains legendary. It can crash 40% in weeks. A tweet, a policy ban, a leveraged cascade, and the price moves like lightning on a dry prairie. It is decentralized, but centralized exchanges still dominate. It is permissionless, but regulators now walk through the back doors. It is finite, but derivatives dilute exposure into shadows. Bitcoin is a paradox, sovereign, yet surveilled. Digital, yet tangible. Free, yet increasingly structured. Which brings us to the old titan, U.S. Treasuries. $36 trillion deep. The most liquid, most collateralized instrument on earth. They underpin everything: money markets, pensions, bank reserves, insurance liabilities. They're the invisible scaffolding of capitalism. And yet, the scaffolding creaks. On May 16, 2025, Moody's downgraded U.S. sovereign credit from AAA to A1. It was the last major agency holding the line. Now, the illusion of American fiscal invincibility has cracked. Debt servicing costs are ballooning. Over $7.6 trillion in Treasuries matured this year. The government must refinance at higher yields, amid rising skepticism. In March 2025 alone, the trade deficit ballooned to $140.5 billion. Interest payments now consume over 13% of federal revenue, projected to reach 30% by 2035. The debt ceiling, once a formality, is now theater. Political dysfunction, bipartisan sabotage, performative brinksmanship, this is the new norm. And yet, when markets panic, they still run to Treasuries. Why? Because liquidity is king. When the storm hits, nobody runs to ideology. They run to scale. And Treasuries, despite their flaws, offer just that. But here's the deeper layer. These three safe havens, gold, Bitcoin, and bonds, are no longer islands. They are entangled. Tether backs USDT with Treasuries. Bitcoin ETFs are custodial products held by firms like BNY Mellon and Coinbase. Gold is tokenized on blockchains. Treasuries are increasingly collateral for crypto derivatives. The boundaries blur. The fortress gates are interconnected. And this creates a meta risk, reflexivity. What happens if a run on Tether forces it to liquidate Treasuries? What happens if Bitcoin crashes and causes outflows from ETFs, which are forced to sell collateral? What if a geopolitical shock sends gold surging, but drains liquidity from everything else? Safety becomes not just about what you hold, but what that holding is linked to. So let's reframe the question. It's no longer, which asset is safe? It's, under which conditions does each asset fail least catastrophically? Gold performs in monetary debasement. It rallies when fiat trust collapses. When Argentina defaults, or when Lebanon prints its currency into oblivion, gold shines. Bitcoin performs in capital flight and financial censorship. In Nigeria. In Venezuela. In Ukraine. When you need to leave, but can't carry anything, Bitcoin is your keystroke escape. Treasuries perform in institutional panic. In 2008. In 2020. When banks seize and credit freezes, the entire system floods toward U.S. sovereign debt, not because it's perfect, but because it's the global default setting. Each asset excels in different crises. Each one fails in others. The smart investor doesn't pick one horse. They study the track, the weather, the horses, the rules of the race itself. Here's what that strategy might look like. Checkmark: use gold as an anchor. Slow, steady, uncorrelated. Checkmark: use Bitcoin as a hedge against state overreach and currency collapse. Checkmark: use Treasuries as a liquidity core, but monitor debt auctions and ratings. But here's the twist. None of this works in isolation anymore. Because risk no longer lives on the periphery. It lives at the core. In the US debt spiral. In Europe's stagnant demographics. In Japan's zombie bond market. In China's silent slowdown. The old, safe zones are now the epicenters of instability. What happens when the next default isn't Sri Lanka, but Italy? What happens when the next liquidity crisis comes not from mortgages, but from a treasury auction that fails? What happens when the smart money doesn't know where to go? Then, safety becomes a strategy, not a substance. It becomes posture, not place. In such a world, you don't just hold gold, you hedge its storage jurisdiction. You don't just own Bitcoin, you self-custody, multisig, root via privacy layers. You don't just buy treasuries, you ladder durations, watch foreign buyer participation, and stress test rate volatility. This is no longer asset allocation. This is defensive architecture. And it's necessary. Because history shows that safe havens work, until they don't. In 1933, America confiscated gold. In 1971, Nixon severed the dollar's link to it. In 2008, U.S. Treasuries nearly buckled until the Fed intervened. In 2021, Bitcoin drew regulatory fire for energy use. In 2025, it's part of government reserves. The fortress keeps evolving. So the real safe haven? It's adaptability. Not just the asset, but the architecture of your decisions. In this new age, where inflation can be imported, debt can metastasize, and capital can evaporate faster than a tweet spreads, you don't bet on safety. You bet on agility. Because sometimes, the fortress is not a vault. It's a path. A shifting, living hedge, moving across jurisdictions, platforms, asset classes. A strategy for surviving not just volatility, but transformation. That's the game now. That's the edge. Thank you for watching FluxFolio Finance. Like, subscribe, and tell us below. Where do you seek safety when the storm comes from the sky, the sea, and the code? Gold? Bitcoin? Bonds? Or something more abstract? A way of thinking that stays sovereign, not just your wealth. Because in the end, safety may not be a place. It may be a discipline. It may be you.